Hello again, and welcome to Tuesdays with Lloyd's. Today, we will continue our focus on the digitization of the markets and how that may affect the future of underwriting. Our title card sums it up pretty well: digital underwriting. If you can measure it, you can manage it. I'm sure our two guests will help unpack that a bit today so we can better understand what's on the horizon and how it might impact the way we do our jobs. Before we kick off, just a few reminders. We encourage you to submit questions during the session. Please use the Q&A tool instead of the chat. And also make sure that, lost my notes here, excuse me. We'll have time at the end of the session to address your questions, but please do use the Q&A tool. Our sessions are streamed live on Lloyd's YouTube channel and add to our growing library of specialist topics, including nearly every Tuesdays with Lloyd session to date, all accessible for your online viewing demand 24/7, so be sure to check it out. So let's go ahead and meet today's panel. Ben Laidlaw, Chief Technology Officer with Carbon Underwriting, and Jamie Martin, Head of Underwriting for Vave, Canopius's algorithmic underwriting MGA. Ben, Jamie, welcome to our virtual forum today. Let's just jump right in and I'll turn it over to you.
Thank you very much, Pat, for that introduction. Thank you, everyone, for joining us on this session. We'll try and keep it as interactive as possible. So, as Pat said, please drop any questions you have within the Q&A box, and we'll try and answer them as we go. And if we haven't got to them, we'll try and answer them at the end, as long as they are not too difficult. So, Ben, what can you tell us about carbon and yourself?
Thank you, Jamie, and good morning, everyone. Fantastic to be on the panel. And as Jamie and I were discussing beforehand, we did say that please do send through the difficult ones, and Jamie's very happy to handle them live for everyone. So look, I'll introduce myself briefly. I'm not here to kind of give a huge sales pitch, but what we're up to. But I think it's important just to qualify the experience with which we're bringing today. My name is Ben Laidlaw. I'm CTO and portfolio manager for Carbon Underwriting, which is a Lloyd syndicate. We've recently, we were the first kind of organic syndicate in a box, which is a new scheme Lloyd's put forward to bring kind of innovative new underwriting methodologies into Lloyd's market, and it allowed us as Carbon, who originally were trading as an MGU, to access the Lloyd's franchise at a much lower size scale than would typically be required to kind of launch to full syndicate status. As a business, our focus is very, very much on delegated authority business. So we write exclusively through portfolios, and we do so in a technology-enabled and data-enabled manner. And that's kind of, I think, at least one of the reasons why I've been asked to talk today, is professing or pretending to know something around the data stream, and specifically around the portfolio business. Our approach is one of partnership. We really, really do like to engage with cover holders in a manner that's a fewer but larger approach. We like to engage with cover holders and partners who have a similar approach to us, and do so in a sophisticated manner. And again, everything really is backed up by our tech platform, Graphene, which is a key focus of ours. Graphene for us is the platform that takes data, takes bordereau data, takes cover holder data, and it streamlines it such that we can analyze and review portfolios live when it comes to portfolio underwriting. So that's a key kind of brief five-point intro to what Carbon does. I think importantly, what my background is I am an underwriter. So while CTO appears on my business card, I think that's because we just wanted to make me seem a little bit more qualified than I am. But the point is that as I'm an underwriter who's come to technology, what I'm not is a technologist who's come to underwriting. And I hope this theme will be evolved throughout this kind of discussion, that the market needs to really address who's driving the technology change, I think, within the marketplace. And my qualifications are very much one of underwriting, and have bundled together to create a tech platform as opposed to the other way around. I think that probably sums up a little bit about Carbon and myself, my background, and I'll hand over to Jamie to presumably do the same for Vave and let us know what he's up to.
Didn't you do an interesting degree as well?
Oh, Jamie, you're so kind. Yes, so my background was physics originally, and then I did do a master in nanoscience, and that's probably why you'll see along the branding and then the kind of thematic nature of carbon and then graphene, all of these kind of nice carbon bonds and double bonds and diamond language, which really influence our branding and indeed the strength of the firm. So thank you for pointing that out, Jamie. Over to yourself.
Anytime. Yeah, so my background, I've been underwriting since 2004. I started at Catlin and moved to Canopius in 2011. My background hasn't been delegated authority, it's been large ticket DNF property risks. I have a law degree, which I admit wasn't particularly big on data, so nothing nano about it. In 2018, myself and a couple of colleagues got together and started Vave, which, by the way, is Samoan for quick, just in case anyone wondered. But I'm probably absolutely murdering the pronunciation, so I apologize. It's also an acronym for value analysis, value engineering, which was just a lucky coincidence. And essentially what that is the study of creating efficiency within a closed system. So from the start of Vave, we've had support and encouragement from our senior sponsors within Canopius. We set out to reimagine how delegated authority business was underwritten. The aim was to rely on data rather than anecdote. We launched our first product in 2019, selling inland residential flood as a proof of concept. In March 2020, we launched our homeowners product, and in turn, we'll be going live with our commercial product in the next couple of weeks. The philosophy is no touch, not low touch, no touch algorithmic underwriting, and that caters for the full life cycle of the policy. So that's quotes, binds, MTAs, cancellations, and renewals, all without human intervention. We launched as an MGA in 2021, and we're trying to drive as much efficiency out of our underwriting as possible. It should be noted that the first couple of years, we were just building, learning, refining, and collating the data. The costs far outweighed the benefits at that point. Being encouraged to step away from our day jobs and focus on an idea essentially was revelatory. The makeup of the team is slightly unusual. The role of underwriter is changing, and we're a team of 14, and none of us have had any experience within the delegated authority world before. But that shouldn't and hasn't been an impediment as long as we have the appropriate support. Also, interestingly, while the core of what we do is underwriting, 13 out of the 14 people in the team have never previously held the role, have never previously held the title underwriter.
Jamie, who is the underwriter?
I'm the anomaly, which maybe whilst we're talking about data might not mean I'm the most qualified within the team to discuss data, and I'm sure I'll get a certain amount of abuse from the team later on. But the good thing about it is it creates a natural tendency to find novel solutions to traditional challenges and not be encumbered by that legacy. And I suppose on that point, Ben, what do you see as the issues in the delegated authority space that need to be addressed?
Thanks, Jamie. So as kind of highlighted, our raison d'etre is to write DA business, delegated business, but to do it better. I think for everyone on the call, I think everyone's aware of cover holder or scheme or delegated business, that mechanism of using third parties to write on your behalf. Now, for me, the principal issue, well, I think in any kind of distribution chain, the issues tend to be around distribution cost. And then additionally, there is that data flow to support your underwriting decisions. Now, in the DA space specifically, that really is around the bordereau. And I'm sure some certain people who have worked in an underwriting role or produced bordereau or worked with bordereau often have a little shiver. I still do when the bordereau is mentioned, because it can be an absolute nightmare in terms of data standard. The mechanism for creating bordereau, those ways of building and sharing that risk information and claim information and transaction information, it is antiquated. And while it's sent by email, it's put in a spreadsheet, frankly, it's not really any different to just posting something by mail. And indeed, I think there could be an argument that sometimes post we get certain parts of the distribution chain quicker than it does to produce that bordereau and share it. And if we are referencing a property account, which obviously Jamie does principally kind of work on, we found that by the time information about a risk gets from the cover holder or the end client through to the either capital provider or reinsurer or the end kind of holder of that risk, you can be looking up to like 6 or 9 months. And it's just madness in this interconnected world, and the fact that you have a huge connection and web of data that communicates, and you've got emails flying around, and people are able to share this information instantly. You're still looking at 6 to 9 months. So I think for me, that is the principal issue, that border and that time delay. With that time delay definitely comes the data quality and data standards that sit alongside it. So you find that, I see one of the questions is saying, do you write business worldwide, or is it USA, Europe, etc.? So it's worth kind of quantifying that as a business, we do international business. We write some US business, not to our syndicate. But we have a kind of a truly global footprint on that book, and one of the issues with writing kind of global business is you do end up with differing data standards, and you end up with a bordereau that comes from the US looking very nice and a chord standard, which is obviously fantastic and we love using, and then something like Canada will be a lineage format, and then out of Australia it does frankly whatever they want to do, and it becomes a lot of the problem is kind of dealing and homogenizing, standardizing this data, because unless you have data quickly, unless you have data in a format that you can utilize in a standard format, you're just not going to be able to utilize it to drive decisions. And I think that's kind of pushing to that value add, which Jamie's alluding to. You really got to be able to get that information in the hands of decision makers, because we're still a human-based firm supported by technology, or not in the hands of decision makers in Jamie's firm, and have the tech do it. That you need that data to be transferred quickly, such that decisions can be made by someone or something. So I guess that was kind of a brief foray into where I see the issues in the DA space, and were a follow-up question to be what drives those changes. It is unfortunately, it's the lack of data standards, and those global data standards are really tough to enforce. And I know Lloyd's doing a lot at the moment with the core data record, it's all about defining how that data is transferred, which isn't a spreadsheet in one of kind of 20 formats. I mean, so obviously we live and breathe, Jamie, by the bordereau, and that's very much a really strong part of our competitive advantage, the utilization of that. I mean, what kind of data has been utilized at Vave?
Yeah, thanks, Ben. So just as just rounding off the question for Anthony's question that he posed, we are USA only. Our business is only North American, and it's a contiguous state to the US as well at that. So we sort of thought it was a big enough market for us to play in, and therefore that's what's limited us. You know, we'll slowly expand, but we don't need to at the moment. So yes, so examples of the way the data is being used in what we do. So it's probably important to draw a distinction with data that we're collecting as we quote and underwrite risks, and the data we built our models on. Ultimately, they both end up in the same place, amending that or improving that virtuous cycle of underwriting. But it's probably worth talking about them separately. So we currently collect about 800 bits of information on every risk that we quote. And some of this comes from our distribution partners we are integrated with, but also we undertake several third-party data calls within the pricing workflow. Some examples of the third-party calls would be geocoding the location, satellite imagery to consider quality of the roof, and independent valuations, which is clearly a hot topic at the moment. We're quoting on about 13,000 personal lines risks a week, which equates to about $4.5 billion worth of quoted premium per year, and that's one of our products. With all this data flowing through the system, we're able to discern signal where traditionally it would have been invisible. In fact, the data enrichment that we're undertaking is increasingly being highlighted by our algorithm as the best predictor of loss. It's also worth noting that the data is stored off in a consistent, structured manner that allows us to go back and interrogate at a later stage. So to Ben's point, it's about getting into a format that you can do something with. We store it off in our data puddle. We don't really have enough data yet to build a lake, but it's growing day by day for both bound risks and quoted risks.
And Jamie, how much time was spent? You mentioned how there's a lot of expense and a lot of time invested in the building of the system. In terms of your data puddle, or perhaps data droplet at first, what kind of investment was going on, and how? So I know for us, the answer is longer than you'd ever imagine.
Yeah, it was. It was whatever time you think it's going to take, just double it and add some. And that's the thing, is probably it's time. It's that taking that step away from your day job to spend the time doing something that is, broadly speaking, really quite mundane, but it's really important. So creating that structured data that you can then do something with. And to that point, I suppose the reason it takes so long, as I said, is that we're collating, validating, and linking the database to make it big enough to build an underwriting engine that we have confidence in and our actuaries have confidence in. So we were fortunate enough to get together a data universe of $2 trillion worth of limit with linked premium and claims. And then from that, we've built out our underwriting data set, or the model, the data set on which the model was built. So back to the 4.4 billion, if we were to build up a data set of equivalent size to the 2 trillion, it would take us 55 years on our current bind rate to come up with a data set that size. So so we had quite a decent head start. The beauty of a data set that large is it allows us to parameterize our models beyond just cat and non-cat. So we've built individual models for sub-perils within these broad categories. And as the title of the talk says, if you can measure it, you can manage it. We're acting learnings coming out of that data, even since we've launched. And as I said before, identifying the signals that would have previously been, wouldn't have been discernible otherwise. The cadence of the updates and improvements will only increase as the data flow increases as well. And importantly, we're storing off all of this data so you can backtest theses that otherwise you wouldn't have been able to backtest. The bit, however, that I think probably gets me more excited than perhaps others in the team is that gaining insight beyond what an individual data point says. So going beyond what could have been garnered from a PDF bordereau, and gaining that sort of haptic feedback, a feel for the buying behavior of the end consumer, is something that would have been impossible without building out the infrastructure we have in place. So to your point, Ben, it's about laying down those foundations early and taking time to do it correctly, so that you can then reap the benefits of it later. And then finally, on the claim side, we're currently integrated with our TPAs, which gives us greater insight into losses as they happen. That's how to increase the accuracy and speed with which we reserve.
Just in terms of that, I know you're referring to haptic feedback. Are you able to give an example of some way you've changed a quote engine or a product off the back of that?
Yeah. So when we first went live, and we're quoting inland flood, we saw a sudden spike in quotes in one town in the middle of the US, and sort of slightly unusual. And so we had a look into it, and it turned out that there was a dam upriver, and everyone in that town had received a letter saying the dam might burst. And so there was a sudden spike in flood purchasings. So we just turned it off. And we didn't allow any more quotes to go out. And in a different world, that would have been the dam didn't burst, by the way. If in a different world, that would have been something you would have found out about, as you said, from a news story, or a couple of months later, probably through bordereau. Oh, I was on that risk. Okay, how did that happen? Whereas this way, we were able to react to that actual individual buying behavior that's starting to become apparent from the data that comes through, and that data set is live as and when something's bound. We're aware of it. So yeah, leading question for you, Ben. Is having better data actually worth it? Does more data and more sophisticated approach always lead to profitability?
Yeah, it's obviously a slightly leading question here. It's slightly glib and tongue-in-cheek about, does it actually make a difference having more data? And certainly ease of access to data is a really interesting topic. I mean, if you kind of break your profitability down into kind of three chunks for me, you've got kind of your underwriting result, there's the internal expense and the external expense. So in terms of having more data and a more efficient way of trading, I'd like to think it's evident that having more data will definitely drive changes in profitability. And I mean, we don't quite have anything as extreme as we suddenly getting loads of quotes through on in the shadow of a dam, and which I can really see the evident kind of value of data, and not just that data, that ability to analyze it. And it's one of those cases that I think a really interesting change that happens is you could provide all underwriters currently, or non-underwriters in Vave's case, but you could provide all underwriters with an infinite amount of data about all their risks. But what is interesting, that pricing methodology then needs to change. Like we always joke about, we always use the phrase like something with a blue door, right? So do houses with a blue door drive more claims? It's like, well, hopefully that's great, but how do you find out in the first place whether or not houses with a blue door, well, if they've got a blue door, and then B, if they actually do have less or more claims on your kind of on your books of business? So does it drive profitability? Yes. Are people ready to use more data in a manner that's going to be useful? I'd question it. I think there's certain examples, and there's a very good platform in the London marine market, which is a very, very data-focused methodology of underwriting and pricing marine risk. And I think it is evident that a lot of entities would value from this, and you can point out straight away, you've got, I don't know, two different marine, I don't know if it's ships, and one is the crane, one doesn't have a crane, and one with the crane has all the losses. But as part of a typical submission to an underwriter, they'll never know if that crane's there. And so it straight away demonstrates that you're going to get more profitable business, or you're going to have better underwriting results utilizing that platform. But the market just didn't want it. And all like these kind of old, I hate to say it, dusty kind of Lloyd's underwriters, they just didn't want to utilize this platform because it's not how they trade. And frankly, it's in danger of kind of not quite putting them out of business, but certainly changing and asking people to modernize. And that lethargy and that reluctance to change, I think, is an interesting one. So is having better data worth it? Yes. Is the market ready for it? Just about. And I think you're seeing changes. I know one of the questions is regarding Blueprint 2 plans, and it's specifically aimed at Vave, but I can certainly say for carbon, a huge focus of ours has been to build our syndicate, build our approach solely focused around this future. And the market has recognized that these data platforms and data streams and data services are really required. And in doing so, it's put forward this very, very well-established route from not trading digitally to trading digitally, and it's, I think, from my point of view, really welcome and really, really necessary for that change. So that's going to help your market acceptance. The second thing of internal expense, straight away, if you have more and more individuals who are able to utilize data and handle data and price off data, it does remove that kind of was it discretionary underwriting? I didn't quite catch the term earlier, Jamie, but that the nature of the underwriter making a decision, you have to make those decisions utilizing the data, which means having a more streamlined workforce. There's less data analytics internally as well, if you are providing information in a good manner. And then finally, and I hope there aren't too many brokers on the call, from an external expense point of view as well, it will drive it down, because people's handling of accounts will simply get faster and quicker and better, because there'll be less transcribing your information, there'll be less data moving and typing from a slip to a schedule, from a schedule to statement of works, etc. So is it worth it? Yes. Does it lead to profitability? Yes. Are we quite ready for it? Just about, I think, is what I put on that.
And how do you go about measuring that? How do you measure yourself against the market? How do you demonstrate that what you're doing is better? Because that's the bit, isn't it?
Yeah, no, it absolutely is. I think in terms of how you can, on a short-term basis, it's difficult. I think because Lloyd's results are published on a certain frequency, even within Lloyd's results and Lloyd's risk codes, it's actually quite hard to point out specifically that carbon's come here and Canopius has come here, or the other way around. I'm not sure which one's better on that height scale, but so that is tough. I think the information and the conclusions we're drawing from the data at present really, really are to us suggesting that we must be more profitable in the manner that you're saying, that dam example. It's not possible for the underwriter who's actually quoting all those accounts, not in the knowledge of the dam, to be able to realize that there's this big exposure in the portfolio. So it's quicker to realize your profitability, but probably equally quick to find out against any other method that you're writing when compared to other markets, I'd say.
Sure.
I mean, for yourself, Jamie, are you able to quickly compare yourself to other aspects of the market? I would say probably, like, we probably should be, I feel.
It feels like we should be able to. It's difficult to do though with any real certainty, because again, no one wants to share that, really, do they?
Yeah, exactly.
So from the just to answer the question about Blueprint 2 from the anonymous attendee, how closely aligned was the development of the Vave platform with the Lloyd's Blueprint plans? This probably isn't the right forum to say it, but we didn't read Blueprint 2 before we started building this. It was, I think, November 2020 from a quick Google. Is that right?
Jamie, what you're referring to there is Blueprint 1.
Blueprint 1? No, we didn't. I'm afraid we started building it completely unaware of Blueprint. And so we are just sorry. That's probably not the right thing to say on this forum. I apologize profusely. Other Q&As that we need to do before we move on to the next question. Can you please comment on practical examples for underwriting on cyber? I have no idea.
I also am going to fall back on that as an answer there.
I'm sure that the moderators can point in the direction of a decent cyber underwriter. So Jamie, do you operate in all states in the USA? No, we don't. It's the contiguous states. So Alaska and Hawaii, we don't have maps or data to justify building out a model there. So that's something that so it's the mainland states. And that other question's a bit long, so I'll let Ben read that whilst I'm answering the next question, which he's about to ask me.
Okay, so it's amazing, because actually I think your answer to the next one may kind of sit alongside this. So where are you at Vave bringing efficiency to how data is consumed and actioned on that one, Jamie? So what are you doing differently? And that efficiency, I think, is really right, and it does point to Maria's question around, is it harder and more tedious when you've got too much data? I think is effectively the point of the second paragraph there.
It is a good question. So, and I suppose it speaks to what you were talking about earlier, Ben, which is about that delay to get data from A to B. So let's talk about it. So the fidelity of data granularity from policyholder to ultimate risk bearer, that's essentially what we're talking about, which is a fancy way of saying we want our capital partners to have the ability to drill down to individual risks within the portfolio and identify the risk characteristics that are driving that pricing. The transparency of that data journey is of paramount importance to us, and something that we've come quite a long way along the route. So if our capital provider would like to look at an individual risk within the portfolio, they can do. Due to the modular nature of what we've built out, you can then drill down into what is driving the price and by how much, in order to create full transparency of the decision-making process. So is more data tedious? It depends what sort of data is. I'd probably point you to some reading on the internet about big data. So there are 5 V's of big data, which I can't remember now because I sound a little bit like.
Is Vave one of them, Jamie?
Vave is definitely not one of them. I think there's volume, veracity, value, and a couple of others. But I would definitely suggest that you look at that. So variety. So that's the important one. Variety on your question, Maria, which is it depends what sort of data it is. So if it's all the same, if it's structured in a format you can consume, if it's sort of slightly pre-chewed so you can then put it into the warehouse so you can then interrogate it, that is beautiful. That's sort of stuff we would take all day, every day. If it's information that is disparate, fractured, broken, unlinked, then no, then you're right. There's a lot of effort involved in sorting that out. So yeah.
And on that, I think the let's go back to that world of the infinite amount of data that sits there, right? For your day-to-day trading, and I think your ability to handle data will become hopefully is very quickly becoming the IP of insurance firms rather than necessarily the rates that sit behind their products. And your ability to kind of ingest and handle it is really key to your profitability and your ability to handle that data. And your day-to-day, if it is something as simple, and I hope James is going to tell me his algorithm is a bit more complicated than TIV and location times a rate, but it's when you start to ask those speculative questions. So we've got this portfolio of essentially, and it sounds a lot worse than this, Irish pubs, right? So we insure a load of Irish pubs for people tripping over because they've had a few too many beers. Now we were like, so we had this theory that TripAdvisor reviews would be able to be aligned with the safety or the quality of the environment. So they like got a theory, got a hypothesis, let's work out if we can go test it. So when you're that first point of being like, right, let's try and find TripAdvisor reviews, and how do you grab them? How do you have them in a manner that's usable? And how do you, once you've got them in a structure that's usable, can you then drive that underwriting conclusion for them? And actually that last stage isn't necessarily that hard because you've got the data and you know what you want to do with that, and you know what your wanted conclusion is. But getting that stuff, you think it'd be easy, every website has a TripAdvisor review, but actually getting that from the website into your database, that's where the difficulty lies, and that's where you're kind of relying on. And it is a lot of we as a firm employ 40% data team versus 60% traditional insurance, because handling and interrogating and being able to ask those interesting questions needs a specific skill set to be able to do so.
Yeah, I think that rings true and probably hopefully answers Maria's questions. Thank you. So on that journey of data from policyholder to ultimate risk bearer, then I suppose the second point of that is that we want to be able to give the ultimate risk bearer more control about the portfolio they're writing, what it looks like, how it interacts with the rest of the book, and that can be dynamic or static, and that's something that that's something that we are trying to bring into and create efficiency within how we underwrite. The next bit, so on the efficiency side, and I've spoken about this before, so apologies, I can get quite animated about claims, which is a weird thing for me to get animated about, but it's just one of those things. It seems really obvious to me that there should be a direct link between the underwriting and claims data, but there often isn't. And the amount of information that's available when dealing with the latter is absolutely phenomenal. And so to shoehorn a hackneyed quote, those who cannot remember the past are condemned to repeat it. If you don't learn from the losses, you'll struggle to improve. So having that data stored off in a manner that is interrogatable is of paramount importance. I think you said it before, Ben, but the data is all out there. It just needs to be collected. And I suppose on that point is there's a group of people who probably got the joke before a lot of us, and that's our distribution partners. So they've made huge strides in recent years, which have allowed us to go on this data and underwriting journey. So thank you. So Ben, is it worth it? Do you think it's possible to move the market when it comes to technology and data?
Look, as an advocate, yes, obviously, I think our firm is firmly behind that. Myself as an individual, I think there is. I think the difficulty lies with that market adoption, and you just alluded to it there, talking about your market partners, and I would guess, and perhaps you could speak to briefly, that you had. Did you have a number of key partners who are like, look, we're going to support you in this journey. We see benefit for it. Let us support you. Was that the kind of conversation that happened?
So essentially, they'd got to the destination before we even turned up, and they had built out platforms that could consume API delivered pricing in a way. So, like I said, they were ready before we'd even conceived the idea, really, and they were fully supportive because I think they just wanted a variety of pricing, and we're sort of eternally grateful for them being so forward thinking about it.
And just to help qualify my answer, were those tier one brokers, tier two, like what kind of size were the entities who had got their ship in order, let's say?
The bigger entities.
bigger entities, and this is it. Is
the biggest of the entities.
The biggest of the entities. So the biggest entities, and I think this is exactly it. Is you have a competitive marketplace that exists, and Lloyd's is a very good example of this because it's got a lot of aligned individuals all looking to place and accept risk, but effectively are all competing. So you've got kind of a true competition there, and there is just, in my view, this it's slightly juxtaposed that for the market to modernize, you need common acceptance. You need everyone to realize this is how we're going to move forward, and everyone needs to know how they're going to ingest data and how to handle it and how to price and how to give a better service to their clients, and all the benefits will gain from utilizing data effectively. But then also we're saying at the same time that you're able to seek your competitive advantage as a firm, and Jamie and nod because you just muted yourself, but you as a firm are basically, I assume your tenants are, you've got a low number of people writing quite a high amount of risk and doing it efficiently and quickly, and an excellent service partner for your providers or your brokers.
Exactly.
And that's what it's all going to be about, is can you turn this stuff around quicker? Can you do it in an effective manner? But if your competitive advantage is to be able to do that in a better manner, as Vave definitely done, and Carbon well on the way to sorting out for our books of business, do I want to share that? Do I want to share my IP? And do you want to share your muddy puddle or a very well structured data lake? And do you want those two data sources? Do I want my IP, which I've taken 2 years to kind of scramble around, do I want to give it to all the other people in the market? And then you've got the whole thing around this lack of data standards, and then that is then driving the lack of acceptance. For two parties to speak in terms of data, they need the same language. And I mean, Accord's doing a lot, as we mentioned earlier, and then in the States, I know that's really, really useful for property. Even just north of the border, Accord is pretty well forgotten about, at least in the markets we're moving in. You go anywhere across the Atlantic, and people have barely kind of heard it from a common usage point of view. So it is really these data standards, and putting back to, can you do it as a small entrant? You can't. But can you do it as perhaps a very well influencing market? And perhaps we know one of those we all tend to work within. Yes, you can. And this is where Lloyd's doing fantastically in the Blueprint 2 stuff. And I think it's highlighted, so a thing called the core data record, which I can talk for a lot longer than I ever professed to want to, because it is a hell of a topic to discuss. But the point being that it's all about, can you find this common ground of data fields which you want to communicate information or data about policies, or more specifically the transactional elements. So not only can you get your underwriting competitive advantage, but can you also just have your back office working more efficiently? And then what Lloyd's have kind of said is, look, the core data record isn't about finding out how many floors your house has, or whether the door's blue, or how messy the front lawn is. Instead, it's looking at getting the transaction to happen as efficiently as possible, and it's leaving it open for partners and for markets and for insurers and cover holders, etc., for them to forge those relationships, or then drive their competitive advantage on the kind of the exposure-based considerations. So the market's really moving, in my view, and it is definitely moving towards data acceptance, data usage. And I think people are recognizing that IP around handling the data is going to be really key for profitability in the future. But it's very hard to do as a small entrant, and we've been able to do it because we're small, nimble, and we don't have any legacy. But the big boys who really need to drive this change, they've got 18 different policy admin systems because they've grown by acquisition aggressively in the last 5 years. So it's a really tough one. I think we can. I think both our firms are probably trying to do it and doing it quite well. But it's very, very hard to move the market.
Is it moving quick enough in your mind?
When I started, admittedly not that long ago, I thought then it was impossible to change, and already I'm in a position of being in a firm that's changing it quite aggressively. So I think the mindset's changing. The market now accepts that it needs to change, whereas previously the view was it doesn't need to change. So now it's like it needs to. We accept it needs to, and then it's like, right, how are we going to change it? So we're on the way. But then again, as a future-focused small firm, you want everyone to move slowly, because hopefully you can drive that advantage and become the only person in the seas doing what you're doing, and become a market leader. So from a competition point of view, it's an interesting one about whether it moves quickly or not.
Yeah, we're torn as well. The slower that the change happens, the better for us. The reason I'm muted is because I'm on the flight path, and I heard a plane coming over. And also I was having a quick look through the participants, and I've talked a lot about the work that's gone into creating the database, linking it up. And one of the participants was the person who did a lot of that work. So
I love the shout out.
Yeah.
So talking about, and I'm conscious that perhaps we're on a 45-minute session, but I think we could go on, could just crack on. So jump in when you need to, Pat. But Jamie, talking about speed of change and approach to changing, what are you changing at the moment? What's next? What's the big ticket item at Vave? What's going to happen next? Where will we see you in the Insider?
Probably not the Insider. Try and keep it below the radar a little bit. So yeah, I'll rattle through this because it'd be nice to have some time for questions. So in the short term, we're looking to bed down the commercial product that we're launching, watch how it grows, learn, iterate, and improve it. And then looking to, and this one's quite a big one, is looking to access capital beyond that which is held on Canopius's balance sheet. So this year we're going to move beyond a point of representation by seeking FCA approval to be able to write on behalf of other entities. Third on the list is building bespoke portfolios for our capital partners, something I alluded to earlier. It follows logically on from the work we've done up to this point, and being able to accommodate disparate risk aversion and capital requirements down to a granular level would move us some way towards that transparent data flow that we've both discussed. And then finally, as previously discussed, claims. I get really excited about claims. To get it's the person who's just dropped me a note and put me off. To get greater proximity to the claims process is something I think that we would all benefit from. So we're currently integrated with our TPA. So we've made sort of quantum leaps in understanding our claims as and when they happen. But to be more active in that process is something that I think we would like to do. So triaging claims using our underwriting data, whether that's live or stored off. And then providing build up sort of insight into our build up our portfolio, our TPAs, so they can resource appropriately, and then also providing policy information. So at the moment, the process by which they get that policy information is sluggish at best. And then also, if we can then formalize how that data is consumed, that will then only help improve the virtuous cycle of underwriting improvement. So yeah. That's 4 minutes left for any questions. Unless there's anything else that you'd want to fire any questions at each other.
No, I think it sums up really well. I think it's just the view that is it changing quick enough, and it's a slightly flippant question because we all know it's not. And there is a very, very large inertia, and it's not just because Lloyd's cool. Lloyd's are doing some fantastic things in trying to drive that change. But then if you look at Lloyd's and the size of the global insurer like scale, it's one of the entities. It's not the size of the market, and you do end up with who moves first, who defines a standard first. But what the marketplace is supporting at the moment, and there are loads of companies like Carbon and Canopius, or I say loads, like there are others who are also driving some really exciting parts, and the London market's a really exciting place for modernization and interesting and differing approaches to underwriting, and that's really the exciting part of insurance, and it's the way that we will be able to drive real profits and speed of transaction, which for me is the exciting part. Can you do more insurance quicker and better? And is it possible? And I think it very much is.
There's one more question that's come up in the chat box, Pat, and that's from Axel, who's the guy who did a load of the work, and he's done me over a little bit. He said, is Vave using more machine learning now? A little bit more, Axel, but not masses. So we partner, not machine learning itself, but we partner with an AI company who have done some really cool stuff on our propensity to bind, which has allowed us to target hit rates in certain areas down to sort of county level, if not below. It starts getting a little bit fluffy at that point, but yes, we are working with them, and the data that we are collating lends itself to that. But good question.
Okay, well, I think that probably wraps it up. Ben, Jamie, we absolutely appreciate your taking the time to join us today and provide insight and I guess a little food for thought surrounding these underwriting issues. And we hope you'll be able to join us again in a future episode or installment as part of our technical crew. And that will wrap things up for us today. And we thank everyone for joining us. Be sure to mark your calendar for our next session, which will be on June 21st, when we'll host a roundtable discussion of risk managers, hearing their market perspective and providing insight into their sort of unique role in the distribution chain. As the session ends today, please do take a few moments to complete the feedback questions that will appear in your browser. We very much value your input in helping us to shape our content. And in fact, we always look forward to hearing from you with any comments or suggestions, program ideas, or really just anything related to this, to Tuesdays with Lloyd's. So drop us a note anytime at usevents@lloyds.com. And I guess until the 21st, let's all keep staying connected, and we hope you have a great rest of your week.
Thanks very much.
Thanks all. Thank you very much. Cheers, Jamie. Thanks, Pat.
Cheers. Bye.